Good morning. Today is Thursday, April 30th, 2020, and I'm reading chapter 14 of The Intelligent Investor by Benjamin Graham, Stock Selection for the Defensive Investor. Like I said, my name is May Dodla, and my blog is yesfinanciallyfree.com. So I'm excited to be here. As always, I do this every weekday morning at 8:30 a.m. Hawaii time. So good day and welcome to the live. So I'm excited and let's do it. Now I'm going to do this live on Instagram too. I haven't had many views yet, but I'm thinking today's the day where people are going to pile on Instagram. So everything I say today, by the way, thanks for being live on Instagram. Everything I say today is on my blog, yesfinanciallyfree.com. I'm recording. I'm doing a YouTube video as we speak. That YouTube video is on my blog, yesfinanciallyfree.com. All right. And I have all the YouTube videos in one blog. So if you want to know all the chapters of The Intelligent Investor by Benjamin Graham, then go to the blog. Put your first name and email address on the right side if you haven't done so already to get on the email list. You get a free ebook, Working Parents Guide to Financial Freedom, if you subscribe. It's super easy. It's free. You can unsubscribe anytime by clicking a link at the bottom. But I email out good stuff. I email out good content. I am constantly educating myself and my readers about financial freedom. Right? And I walk the talk. Okay. So back in 2011, I had over $41,000 in personal credit cards, dad's loan credit, 8 different credit cards, lines of credit, all kinds of stuff. Right? Hi, Kizar. Welcome to Instagram. How's it going in Pakistan? Nice to see you. So, yeah, by 2016, no debt, quit my job, improved our net worth by $500,000 US. We're making almost $500 a month in passive income. Started Finance Freedom Mastermind groups where I tutor clients on how to become financially free as quickly as possible. Tutor, such a funny word. We have groups. Yeah, you're welcome. Thanks for being on. We have groups. We get together and we mastermind how to become financially free. You can join a group if you like. Go to yesfinanciallyfree.com. Go to products. Check out all the different products we have. Okay. What else do I do? We bought 3 properties in the last 3 years, one of which we converted into an Airbnb business and sold to one of our mastermind members who was also the manager of that property. So he has his own first investment property. We live in beautiful Waikiki. We went on a month of vacation in 2017. I went on my first cruise to Mexico, never been to Mexico. All kinds of things happened for me. Visited family I hadn't seen in years in Niagara Falls, LA, Washington, D.C. It was a great, great time. So I did all this, and now we're having this COVID-19 thing, right? Which is rocking the world, and I'm fine. My family is doing just fine. And my mastermind members are doing fine, which brings me to an important fact. If you're not working on your financial freedom, you will be susceptible to economic crises like this one. So when things happen, you will have bad times come to you. Whereas if you work on being financially free, you will be immune to this kind of thing. So that's another reason it's important to become financially free. Work towards it every day. If you're not growing, you're dying, right? There's no such thing as stability in nature. Things are either growing or they're dying all the time. Nothing stays exactly the same. There's no static anything in nature. Same thing with us. If you are not working towards your financial freedom, you're basically decaying toward poverty. That's all there is to it, guys. It's that simple. So get on it. Get on the email list. Kizar's on the email list. And join me as we learn about cool stuff together, right? So I don't usually read books on my blog, but this whole COVID-19 thing made it harder for me to be more regular about my marketing in the beginning because I have my son at home every day. He's a kindergarten student. So I'm in charge of his school, and that can be challenging. So not only is he home with me, but I'm supposed to be his teacher, which, is okay. But it took me a while to get used to it. So I started reading a book to get me online and motivated and learning, and doing something with my business. Okay. And it's the perfect time. The stock market is down today too, but the stock market is down in general. They say that if you're smart about stock picking, it's a good time. But who's smart about stock picking, right? Warren Buffett. Well, Warren Buffett learned from Benjamin Graham, and this is his book, and that's why I'm reading it. Ray Dalio says this crisis is going to last 3 years, so we have time to become perfect, awesome stock pickers, right? So let's begin our reading of chapter 14. I'm excited. Get on the email. Let's go to the blog. Share this with your friends and followers. So, Kizar, welcome. Okay. Chapter 14 of The Intelligent Investor by Benjamin Graham. Stock selection for the defensive investor. It is time to turn to some broader applications of the techniques of security analysis. Since we have already described in general terms the investment policies recommended for our two categories of investors, it would be logical for us now to indicate how security analysis comes into play in order to implement these policies. The defensive investor who follows our suggestions will purchase only high-grade bonds plus a diversified list of leading common stocks. He is to make sure that the price at which he bought the latter is not unduly high as judged by applicable standards. In setting up this diversified list, he has a choice of two approaches: the DJIA type of portfolio and the quantitatively tested portfolio. In the first, he acquires a true cross-section sample of the leading issues, which will include both some favored growth companies whose shares sell at especially high multipliers, and also less popular and less expensive enterprises. This could be done most simply perhaps by buying the same amounts of all 30 of the issues in the Dow Jones Industrial Average. I don't know how many issues there are on the Dow Jones Industrial Average now, but back then in 1972 or whenever this was written, there were 30. So that makes it easier. There's only 30. Jeez. Okay. 10 shares of each at the 900 level for the average would cost an aggregate of about $16,000. There's a footnote. Because of numerous stock splits, etc., throughout the years, the actual average price of the Dow Jones Industrial Average list was about $53 per share in early 1972. Okay, so 1972. On the basis of the past record, he might expect approximately the same future results by buying shares of several representative investment funds. His second choice, that would be like doing an index fund of the Dow Jones Industrial Average, yeah. Okay, his second choice would be to apply a set of standards to each purchase to make sure that he obtains, number one, a minimum quality in the past performance and current financial position of the company, and two, a minimum of quantity in terms of earnings and assets per dollar price. At the close of the previous chapter, we listed 7 such quality and quantity criteria suggested for the selection of specific common stocks. Yay, this is exactly what we need to learn, guys. Okay. Let us describe them in order. Number 1, adequate size of the enterprise. All our minimum figures must be arbitrary, and especially in the matter of size required. Our idea is to exclude small companies which may be subject to more than average vicissitudes, especially in the industrial field. There are often good possibilities in such enterprises, but we do not consider them suited to the needs of the defensive investor. Let us use round amounts, not less than not less than 100 million of annual sales for an industrial company, and not less than 50 million of total assets for a public utility. Okay, sure. I don't know what it would be now, probably more. Number 2, a sufficiently strong financial condition. For industrial companies, current assets should be at least twice current liabilities. Good to know. A so-called 2-to-1 current ratio. Also, long-term debt should not exceed the current net assets or working capital. For public utilities, the debt should not exceed twice the stock equity at book value. Earnings stability, number 3. Some earnings for the common stock in each of the past 10 years. Number 4, dividend record. Uninterrupted payments for at least the past 20 years. Earnings growth, number 5. A minimum increase of at least 1/3 in per share earnings in the past 10 years using 3-year averages at the beginning and at the end. Okay. Number 6, moderate price to earnings ratio. Current price should not be more than 15 times average earnings of the past 3 years. Number 7, moderate ratio of price to assets. Current price should not be more than 1.5 times the book value last reported. However, a multiplier of earnings below 15 could justify a correspondingly higher multiplier of assets. As a rule of thumb, we suggest that the product of the multiplier times the ratio of book to value. Okay, let's do that again. As a rule of thumb, we suggest that the product of the multiplier times the ratio of price to book value should not exceed 22.5. Okay. So that means the product of the multiplier times the ratio of price to book value should not exceed 22. This figure corresponds to 15 times earnings and 1.5 times book value. It would admit an issue selling at only 9 times earnings and 2.5 times asset value, etc. Oh, okay. Sure, if you say so. Okay, general comments. These requirements are set up especially for the needs and the temperament of defensive investors. They will eliminate the great majority of common stocks as candidates for the portfolio and in 2 opposite ways. On the one hand, they will exclude companies that are too small, in relatively weak financial condition, with a deficit stigma in their 10-year record, and not having a long history of continuous dividends. Of these tests, the most severe under recent financial conditions are those of financial strength. A considerable number of our large and formerly strongly entrenched enterprises have weakened their current ratio or overexpanded their debt, or both, in recent years. Our last 2 criteria are exclusive in the opposite direction, by demanding more earnings and more assets per dollar price than the popular issues will supply. This is by no means the standard viewpoint of financial analysts. In fact, most will insist that even conservative investors should be prepared to pay generous prices for stocks of the choice companies. We have expounded our contrary view above. It rests largely on the absence of an adequate factor of safety when too large a portion of the price must depend on ever-increasing earnings in the future. The reader will have to decide this important question for himself after weighing the arguments on both sides. We have nonetheless opted for the inclusion of a modest requirement of growth over the past decade. Without it, the typical company will show retrogression, at least in terms of profit per dollar of invested capital. There is no reason for the defensive investor to include such companies, though if the price is low enough, they could qualify as bargain opportunities. The suggested maximum figure of 15 times earnings might well result in a typical portfolio with an average multiplier of, say, 12 to 13 times. Note that in February 1972, American Tel-Intel, AT&T, sold at 11 times its 3-year and current earnings, and Standard Oil of California at less than 10 times latest earnings. Our basic recommendation is that the stock portfolio, when acquired, should have an overall earnings to price ratio, the reverse of the price to earnings ratio, at least as high as the current high-grade bond rate. Sorry. high-grade bond rate right now is so low. But let's just keep going. This would mean a PE, price divided by earnings ratio, no higher than 13.3% against an AA bond yield of 7.5%. Okay. Okay. Application of our criteria to the Dow Jones Industrial Average at the end of 1970. All of our suggested criteria were satisfied by the Dow Jones Industrial Average issues at the end of 1970, but two of them just barely. Here is a survey based on the closing price of 1970 and the relevant figures. Basic data for each company are shown in tables 14.1 and 14.2. Number 1, size is more than ample for each company. Number 2, financial condition is adequate in the aggregate, but not for every company. Number 3, there's a footnote. So he has a table. Let me show you the table because he's talking about the table and it doesn't make any sense unless you know the table. So this is a table of basic companies in the Dow Jones Industrial Average. This is the table he's showing. If you want to screenshot it, go for it. There's a table. Okay, let's take a look at this table. 14.1, basic data on 30 stocks in the Dow Jones Industrial Average on September 30, 1971. Okay, so he looked at the Dow Jones Industrial stocks. He looked at the data. He has all the companies. He has their prices. As of September 30th, 1971, he has their earnings per share adjusted for stock dividends and stock splits. Okay, so he took out all the dividends and he took out all the stock splits. Okay, so earnings per share as of September 30th, 1971. Then he has the average earning per share from the 1968 to 1970 3-year period and the average earnings per share from 1958 to 1960 3-year period. And then he has how long they've been paying their dividends, so the year since they've been paying their dividends. And then he also has net asset value and current dividend. Okay, so that's what he's listed. He's listed all these companies. Most of them have a dividend. There's one that doesn't have a dividend, so that would obviously fail his list, right? There are some that started their dividends. Let's see. No, they've all been paying pretty long time. Yeah, none of except for the one obviously that's not paying anything. But all the other ones meet his criteria for dividend payments. And then the earnings per share, you'd have to look at the pre and the post to figure out if they're improving the way he wants them to be growing and all that. So he listed all the data, which is very helpful. So if you had a list like this, it'd be easy. Go through and be like, okay, okay. All right, now let's go back. So he put the basic data for all the companies in his figure, tables 4.1 and 14.2. So 14.2, let's take a look at that. So that's 14.2. And if you want to screenshot it, although it's huge, so I don't know how much you could see if you screenshot it, but it's right there. That's 14.2. Go ahead and do that if you want. Okay. Let's take a look at what this table is. So table 14.2 is significant ratios of the Dow Jones Industrial Average stocks at September 30th of 1971. Okay, so he did all the math, I think, is what he did. So the price to earnings at the end of September 1971, he has that ratio. He has the ratio of price to earnings for the 3-year period of 1968 to 1970. He has the current dividend yield. So instead of the dividend itself, he has the yield written out. He has the earnings growth from the decade, so the prior decade earnings growth. CA divided by CL, figures taken for the fiscal year 1970 year-end company results. I'm not sure what CA divided by CL is. NCA divided by net debt. NCA divided by debt. Oh, okay. Current assets divided by current liabilities. Okay, so current assets divided by current liabilities. And he wants it to be at least 2, right? Because you need to have twice as much twice as much assets as liabilities. So you need at least a 2. NCA, so NCA, I'm not sure. Current assets, NCA, not sure what NCA means, divided by debt. And then he has a footnote, figures taken from Moody's Industrial Manual 1971. NCA divided by debt. And then he has the price divided by the net asset value. So he calculated a bunch of his required proportions and ratios that he needs. Okay, so number 1, size is more than ample for each company. So each company has definitely enough net asset value. Okay, the size. I think the size was net asset value, right? Our minimum figure must be so they need to have 100 million of annual sales and not less than 50 million in assets for a public utility. Okay, so sales, and he doesn't put sales in here though. But I guess he just knows that they make that much in sales. Okay, so number 2, financial condition is adequate in the aggregate, but not for every company. 2, in 1960, only 2 of the 29 industrial companies failed to show current assets equal to twice current liabilities, and only 2 failed to have net current assets exceeding their debt. By December 1970, the number in each category had grown from 2 to 12, so it got worse. So that's an interesting thing, is those big companies were picking up more and more debt, which is not a good sign. Okay, so number 3, some dividend has been paid by every company since at least 1940. 5 of the dividend records go back to the last century. Number 4, the aggregate earnings have been quite stable in the past decade. None of the companies reported a deficit during the prosperous period of 1961 to 1969, but Chrysler showed a small deficit in 1970. So their aggregate earnings have been quite stable. Aggregate earnings. Did he put aggregate earnings anywhere? Oh, earnings per share. Okay, yeah, he did. So he did earnings right here. He did earnings right here. Aggregate earnings per share. Okay, I see. And then he has Chrysler had a negative earning in I don't know. I don't know where he got that. 1970. Oh, earnings growth has negative. Is that Chrysler? No. Okay. Moving on. Okay, the total growth comparing 3-year averages a decade apart was 77%, or about 6% per year. But 5 of the firms did not grow by 1/3. Okay. And here's a footnote 2. Oh, we already did that footnote. Okay, moving on. Number 6, the ratio of year-end price to 3-year average earnings was 839 to $55.50, or 15 to 1, right at our suggested upper limit. Okay. The ratio of price to net asset value was 839 to 562, also just within our suggested limit of 1.5 to 1. Okay. If, however, we wish to apply the same 7 criteria to each individual company, we would find that only 5 of them would meet all our requirements. These would be American Can, AT&T, Anaconda, Swift, and Woolworth. The totals for these 5 appear in tables 14.3. Naturally, they make a much better statistical showing than the Dow Jones Industrial Average as a whole, except in the past growth rate. 3. But note that their combined market action from December 1970 to early 1972 was poorer than that of the Dow Jones Industrial Average. This demonstrates once again that no system or formula will guarantee superior market results. Our requirements guarantee only that the portfolio buyer is getting his money worth. They're saying it didn't do as better as the Dow Jones Industrial Average as a whole, but it did good enough for the money you invested. And this is a table of the 5 companies, or whatever number of companies. five that made their criteria. Right there. That's the table. These are the 5 companies that actually made the criteria, which he puts down their price as of 1970, their price to earnings, and they're all within the price to earnings, I guess. Anaconda's in there, but they didn't. Wait a second. Anaconda wasn't paying a dividend. Yeah, Anaconda's not even paying a dividend. What is he talking about? Wow, he didn't put the dividend in here because they're not even paying a dividend, and he put them in here. Huh. How interesting. Okay. Don't get it. All right, we'll move on. Our application. Okay, blah, 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 blah. Where did I end? If, however, we wish to apply the same 7 criteria to each individual company, we would find that only 5 of them would meet all our requirements. But I don't know why Anaconda's in there. The totals for these 5 appear in 14.3. Naturally, they make a much better statistical showing than the Dow Jones Industrial Average as a whole, except in the past growth rate. Our application of specific criteria to this select group of industrial stocks indicates that the number meeting every one of our tests will be a relatively small percentage of all listed industrial issues. We hazard the guess that about 100 issues of this sort could have been found in the Standard & Poor's stock guide at the end of 1970, just about enough to provide the investor with a satisfactory range of personal choice. The public utility solution. If we turn now to the field of public utility stocks, we find a much more comfortable and inviting situation for the investor. Here, the vast majority of issues appear to be cut out by their performance record and their price issues, in accordance with the defensive investor's needs as we judge them. We exclude one criterion from our test of public utility stocks, namely the ratio of current assets to current liabilities. The working capital factor takes care of itself in this industry as part of the continuous financing of its growth by sales of bonds and shares. We do require an adequate proportion of stock capital to debt. Okay. They have a, footnote. As a consequence, we must exclude the majority of gas pipeline stocks, since these enterprises are heavily bonded. The justification for this setup is the underlying structure of purchase contracts which guarantee bond payments, but the considerations here may be too complicated for the needs of a defensive investor. Okay. In Table 14.4, we present a resume of the 15 issues in the Dow Jones Public Utility Average. For comparison, Table 14.5 gives a similar picture of a random selection of 15 other utilities taken from the New York Stock Exchange list. That's the table, Table 14.4. And for Instagram, here is the table. Okay. Okay, so in this table, he has different utilities. He has Niagara in here. When he wrote this book, Niagara was running, and I was not born yet, but that's cool. Okay, price in September 30, 1971. He has the prices listed. How much did they earn? Estimated for the year of 1971. What was their dividend? What was their book value? What was the price divided by earnings? What was the price divided by book value? What is their dividend yield? And their earnings per share from 1970 versus 1960. Okay. Let's go. All right. As 1972 began, the defensive investor could have had quite a wide choice of utility common stocks, each of which would have met our requirements for both performance and price. These companies offered him everything he had a right to demand from simply chosen common stock investment. In comparison with prominent industrial companies as represented by the Dow Jones Industrial Average, they offered almost as good a record of past growth, plus smaller fluctuations in the annual figures, both at a lower price in relation to earnings and assets. The dividend return was significantly higher. The position of the utilities as regulated monopolies is assuredly more of an advantage than a disadvantage for the conservative investor. Under law, they are entitled to charge rates sufficiently remunerative to attract the capital they need for their continuous expansion, and this implies adequate offsets to inflated costs. While the process of regulation has often been cumbersome and perhaps dilatory, it has not prevented the utilities from earning a fair return on their rising invested capital over many decades. For the defensive investor, the central appeal of the public utility stocks at this time should be their availability at a moderate price in relation to book value. This means that he can ignore stock market considerations if he wishes and consider himself primarily as a part owner of a well-established and well-earning businesses. The market quotations are always there for him to take advantage of when times are propitious, either for purchases at unusually attractive low levels or for sales when their prices seem definitely too high. The market record of the public utility indexes condensed in Table 14.6, along with those of other groups, indicates that there have been ample possibilities of profit in these investments in the past. While the rise has not been as great as in the industrial index, the individual utilities have shown more price stability in most periods than have other groups. It is striking to observe in this table that the relative price divided by earnings ratios of the industrials and the utilities have changed places during the past 2 decades. These reversals will have more meaning for the active than for the passive investor, but they suggest that even defensive portfolios should be changed from time to time, especially if the securities purchased have an apparently excessive advance and can be replaced by issues which more reasonably priced. Alas, there will be capital gains taxes to pay, which for the typical investor seems to be about the same as the devil to pay. Our old ally experience tells us here that it's better to sell and pay the tax than to not sell and repent. Okay, so he has 14.5, which is data on a second list of public utility companies as of September 30, 1971. And he has table 14.6 here, development of prices and price to earning ratios for various Standard & Poor's averages. Oh, probably hasn't gotten to that one yet. So let's do 19. That's table 14.5. Okay. So these are more public utilities. Righty, you can screenshot that if you want. Okay. Investing in stocks of financial enterprises. A considerable variety of concerns may be ranged under the rubric of financial companies. These would include banks, insurance companies, savings and loan associations, credit and small loan companies, mortgage companies, and investment companies, which in parentheses is mutual funds. It is characteristic of all these enterprises that they have a relatively small part of their assets in the form of material things, such as fixed assets and merchandise inventories. But on the other hand, most categories have short-term obligations well in excess of their stock capital. The question of financial soundness is therefore more relevant here than in the case of the typical manufacturing or commercial enterprise. This in turn has given rise to various forms of regulation and supervision, with the design and general result of assuring against unsound financial practices. Broadly speaking, the shares of financial concerns have produced investment results similar to those of other types of common shares. Table 14.7 shows price changes between 1948 and 1970 in 6 groups represented in the Standard & Poor's stock price indexes. The average for 1941 to 1943 is taken as 10, the base level. The year-end 1970 figures range from 44.3 for the 9 New York banks and 218 for the 11 life insurance stocks. During the sub-intervals, there was considerable variation in the respective price movements. For example, the New York City bank stocks did quite well between 1958 and 1968. Conversely, the spectacular life insurance group actually lost ground between 1963 and 1968. These cross movements are found in many, perhaps most, of the numerous industrial groups in the Standard & Poor's indexes. We have no very helpful remarks to offer in this broad area of investment other than to counsel that the same arithmetic standards for price in relation to earnings and book value be applied to the choice of companies in these groups as we have suggested for industrial and public utility investments. It's interesting. Yeah, financial corporations. Good morning, Jordan. Financial corporations are especially vulnerable, as we've noticed with the financial crisis when we had all those banks fail, and then who knows what will happen now. But yeah. Okay. Railroad issues. The railroad story is a far different one from that of the utilities. The carriers have suffered severely from a combination of severe competition and strict regulation. Their labor cost problem has, of course, been difficult as well, but that has not been confined to railroads. Automobiles, buses, and airlines have drawn off most of their passenger business and left the rest highly unprofitable. Jordan, can you either open the door or close it? It keeps slamming. Okay, never mind. It did it on its own. Okay. The trucks have taken a good deal of their freight traffic. More than half of the railroad mileage of the country has been in bankruptcy or trusteeship at various times during the past 50 years. Interesting. But this half century has not been all downhill for the carriers. There have been prosperous periods for the industry, especially the war years. Some of the lines have managed to maintain their earnings power and their dividends despite the general difficulties. The Standard & Poor's Index advanced sevenfold from the low of 1942 to the high of 1968, not much below the percentage gain in the Public Utility Index. The bankruptcy of the Penn Central Transportation Company, our most important railroad, in 1970 shocked the financial world. Only a year and 2 years previously, the stock sold at close to the highest price level in its long history, and it had paid continuous dividends for more than 120 years. On page 234 below, we present brief analysis of this railroad to illustrate how a competent student could have detected the developing weakness in the company's picture and counseled against ownership of its securities. The market level of railroad shares as a whole was seriously affected by this financial disaster. It is usually unsound to make blanket recommendations of whole classes of securities, and there are equal objections to broad condemnations. The record of railroad share prices in Table 14.6 shows that the group as a whole has often offered chances for a large profit, but in our view, the great advantages were in themselves largely unwarranted. Let us confine our suggestion to this. There is no compelling reason for the investor to own railroad shares. Before he buys any, he should make sure that he is getting so much value for his money that it would be unreasonable to look for something else instead. Selectivity for the defensive investor. Every investor would like his list to be better or more promising than the average. Hence, the reader will ask whether, if he gets himself a competent advisor or security analyst, he should not be able to count on being supplied with an investment package of really superior merits. After all, he may say, the rules you have outlined are pretty simple and easygoing. A highly trained analyst ought to be able to use all his skill and techniques to improve substantially on something as obvious as the Dow Jones list. If not, what good are all his statistics, calculations, and pontifical judgments? Suppose, as a practical test, we had asked 100 security analysts to choose the best 5 stocks in the Dow Jones average to be bought at the end of 1970. Few would have come up with identical choices, and many of the lists would have differed completely from each other. This is not surprising, as it may at first appear. The underlying reason is that the current price of each prominent stock pretty well reflects the salient factors in its financial record, plus the general opinion as to its future prospects. Hence, the view of any analyst that one stock is better buy than the rest must arise to a great extent from his personal partialities and expectations, or from the placing of his emphasis on one set of factors rather than on another in his work of evaluation. If all analysts were agreed that one particular stock was better than all the rest, that issue would quickly advance to a price that would offset all of its previous advantages. Our statement that the current price reflects both known facts and future expectations was intended to emphasize the double basis for market valuations. Corresponding with these two kinds of value elements are two basically different approaches to security analysis. To be sure, every competent analyst looks forward to the future rather than backward to the past. And he realizes that his work will prove good or bad depending on what will happen and not on what has happened. Nevertheless, the future itself can be approached in two different ways, which may be called the way of prediction or projection and the way of protection. Those who emphasize prediction will endeavor to anticipate fairly accurately just what the company will accomplish in future years, in particular whether earnings will show pronounced and persistent growth. These conclusions may be based on a very careful study of such factors as supply and demand in the industry or volume, price, and cost. Or else, they may be derived from a rather naive projection of the line of past growth into the future. If these authorities are convinced that the fairly long-term prospects are unusually favorable, they will almost always recommend the stock for purchase without paying too much regard to the level at which it is selling. Such, for example, was the general attitude with respect to the air transport stocks, an attitude that persisted for many years despite the distressingly bad results often shown after 1946. In the introduction, we have commented on the disparity between the strong price action and the relatively disappointing earning records of this industry. By contrast, those who emphasize protection are always especially concerned with the price of the issue at the time of study. Their main effort is to assure themselves of a substantial margin of indicated present value above the market price, which margin could absorb unfavorable developments in the future. Generally speaking, therefore, it is not so necessary for them to be enthusiastic over the company's long-run prospects as it is to be reasonably confident that the enterprise will get along. The first, or predictive, approach could also be called the qualitative approach, since it emphasizes prospects, management, and other non-measurable, albeit highly important factors that go under the heading of quality. Second, or protective approach may be called the quantitative or statistical approach, since it emphasizes the measurable relationships between selling price and earnings, assets, dividends, and so forth. Incidentally, the quantitative method is really an extension into the field of common stocks, of the viewpoint that security analysis has found to be sound in the selection of stocks and preferred stocks for investment. In our own attitude and professional work, we were always committed to the quantitative approach. From the first, we wanted to make sure that we were getting ample value for our money in concrete, demonstrable terms. We were not willing to accept the prospects and promises of the future as compensation for a lack of sufficient value in hand. This has by no means been the standard viewpoint among investment authorities. In fact, the majority would probably subscribe to the view that prospects, quality of management, other intangibles, and the human factor far outweigh the indications supplied by any study of the past record, the balance sheet, and all the other cold figures. Thus, this matter of choosing the best stocks is at bottom a highly controversial one. Our advice to the defensive investor is that he let it alone. Let him emphasize diversification more than individual selection. Incidentally, the universally accepted idea of diversification is, in part at least, the negation of the ambitious pretensions of selectivity. If one could select the best stocks unerringly, one would only lose by diversifying. Yet within the limits of the four most general rules of common stock selection suggested for the defensive investor on page 53, there is room for a rather considerable freedom of preference. At the worst, the indulgence of such preferences should do no harm beyond that it may add something worthwhile to the results. With the increasing impact of technological developments on long-term corporate results, the investor cannot leave them out of his calculations. Here, as elsewhere, he must seek a mean between neglect and overemphasis. Okay, so that's the end of chapter 14, The Intelligent Investor by Benjamin Graham, Stock Selection for the Defensive Investors. My name is May Duldalal, and my blog is yesfinanciallyfree.com. Definitely visit the blog, put in your name and your email address on the right side, and get on the email list. Get your free ebook, Working Parents Guide to Financial Freedom. Check out the products page, see if you want to join a mastermind program, or if you want to join any of our other programs. We have a quick kind of boot camp thing, 7-day financial freedom challenge, which is make 2 streams of passive income in 7 days. If you're not making any passive income, you should take that challenge. It's very conservative, but it's something everyone should do. It gives you instructions on how to open and fund a high yield savings account and how to buy your first dividend yielding stock of your choice. Basically, that's how it is. But if you've never done it before, it's like the best training ever, and it only costs $7, guys. And my prices of products range all the way up to $5,000, depending on what you like and how much coaching. Now, the great thing is, I am very smart and absorbent, and I read and I do things and I learn and I grow. And so, if you want someone to hold your hand, someone who's actually doing all the work and wants you to give you kind of like the digested viewpoint, then work with me in a mastermind group. And then you know that I'm studying all the time and reading and growing. So you will be growing with someone else and get some special one-on-one attention. That would be the mastermind group, which is $5,000 a year. Have a great day, guys. Love you. Take care. Aloha. Bye. Subscribe to the YouTube channel if you haven't already. And if you're on Instagram,